Okay, this is the first chart of the new year. Now, I know I did a video last week, but all the rates on the video last week were from December 30th. This is our first view of 2023, so we do have a new chart. So rather than having the year-to-date high, I have put the cycle high, meaning the tightening cycle. So that we still preserve the high points on the yield as opposed to looking at year-to-date highs. We may lose focus of where the high point for each of the yields were. And the first line of the chart now is the rates as of January 1st. And since this is the first week, our second row is identical to our first row. And this is the closing rates as of January 6th. For those that are unsure of how this is done or how I do this screen, all of these rates are available at treasury.gov. If you look in the description box of every video I do, you'll see all the links to where I get all of the data. And when I get to slope, this is done in Excel as well, and it's just calculation, right? So this is the 2 to the 10 year. So for example, for January 6th, for negative 0.69, how do I get that? Well, you go across the column for January 6th, and you would select 3.55 minus the 2 year, which is 4.24, and you'll get negative 0.69. And this is just a chart of this particular, wherever we happen to be in terms of the nominal rates. I've added the 4-month in. This is the first chart that has the 4-month yield in there, so you can see that the 4-month is sitting down here in the chart. So let's begin. Have a look at the 30-day, 4.32. You'll recall that for the last month this was a bit of a puzzle. The Fed raised rates in December to the target range of 4.25 to 4.5, but the 30-day rate actually decreased all the way down to 3.8 going into the end of the year. So my thinking was, well, money must be moving to someplace safe to end the year. Maybe there was some tax loss selling, and rather than deploy that money, it moved into a lot of the 30-day paper, just because it needed a place to be and it wasn't too concerned about the yield it was going to get. It just wanted to get past the year, and here we are now at 4.32. When you consider that the reverse repo rate, which is at the bottom of the screen here, is 4.3, the repo rate is 4.5, 4.32 makes a lot more sense. All of the money market rates have increased except the 1 year, and for cycle highs, they've all hit a cycle high up to the 3-month. The 4-month is just you could say that it's pretty much there, right? 4.74 to 4.76, but still on a pure basis it didn't hit a cycle high. Capital market rates have all decreased. That is a flattening of the curve. It's a bull flattening of an elevated curve. So if we were in our steepener trade, we lost 16 basis points in our steepener trade, but I think from the time, if you started at negative 76 basis points, you're still positive on the steepener trade. The 2s to the 10s have been inverted now for 186 days. And to put that in context, the 2 to 10 inversion, the next longest 2 to 10 inversion was February 2nd to December 28th of 2000, was 330 days. So there's about another 140 days to get through, about another 20 weeks to match that long inversion. The 3-month to the 10-year, this is a shock, over 100 basis points inverted, 112 basis points, which comes from a combination of the 3-month rising 33 basis points and the 10-year falling 33 basis points. So a 66 basis point change between the two. 112, that's 74 days now. And to put that in context, July 17th, 2006 to May 25th, 2007 was the last inversion of the 3-month to 10-year. It was 342 days, but it was only 60 basis points We're 112 basis points. In fact, if you go to Fred and you call up the series for the 3-month 10-year, it's never been deeper. And that goes all the way back to 1981. You've never had a deeper inversion in the 3-month to 10-year curve. Now, I've said in past videos that while every recession has been preceded by an inversion of the 2s to the 10s, not every inversion of the 2 to the 10 leads to a recession, because you can get a 2 to a 10 inversion in a high growth environment. You usually get an inversion of the 3-month to the 10-year in a low growth environment. And this is typically why it is a precursor to a recession, because shocks happen all the time. And if a shock happens in a low growth environment, it is more likely to cause a recession than if a shock happened in a high growth environment. And there has been a question that I was asked on LinkedIn of why is it that the 3-month to the 10-year inversion is a forecaster, or so far 100% forecaster of a recession. What is it about the inversion that is forecasting the recession? Does the inversion cause the recession, or does the inversion forecast the recession? Now, those are two different things. For one thing to be a causal factor, you would have to have an inversion of the curve, which would then change behavior in one of the components of GDP. C plus I plus G plus X minus M. Well, it's hard to make an argument that an inverted yield curve will change your trade balance. So we can get rid of that one. It's probably also difficult to come up to the conclusion that an inverted yield curve would change government behavior. So we'll get rid of that. Although it may change the issuance of the amount of treasuries, it probably isn't going to change the amount of money being spent. So it must happen with C or with I. The C argument is as follows. With money market rates so high at the short end of the curve, it's going to pull some money at the margin away from consumption towards savings. So for some households don't have any savings. Their marginal propensity to consume is 100%. You have some other households whose income and wealth are so high that they're indifferent to these types of rates. They would just simply shift some of their savings from this type of security to that type of security, but would not increase their savings. But there is a group of households that at the margin would look at those rates and say, rather than buying this, or rather than taking out this kind of loan to remodel the kitchen, why don't we take the money that we would have used instead and buy these money market securities, and then when rates come down, we'll then remodel our kitchen. So at the margin, it would draw money into money market rates. And if it draws money into money market rates, there is a belief that, well, that would lower demand, which would lower inflation, and that would start to show up in the longer dated part of the curve, which is typically beyond from about the 5-year to the 10-year. It would start to show up in there. And that would start to take inflation expectations out of the longer term rates. The other part of it is investment. If there is a belief that consumers are pulling back on current period consumption in favor of savings, businesses will also pull back on investment. And if they pull back on investment, investment creates employment, because you're going to build a factory, buy equipment, that kind of thing. If you're going to pull back on investment, where is future growth going to come from? So then future growth starts to get priced out of the curve, and that's how you get that inversion. But that's not the end of the story. We need cause and effect. So there is the cause of an inverted yield curve is expectations. If you want to change how people behave, change your expectations, because expectations can become reality. So if you expect something to happen, you will start to position yourself in anticipation of that thing happening, and that very positioning could be the very thing that causes that thing to happen. So if you have consumers cutting back on demand, And if you have businesses cutting back on investment, well, the C component and the I component will both decrease in GDP, causing GDP to decrease. The observation that GDP has increased will cause more of this to happen, which causes more of GDP to increase, and you get this feedback loop. And that is really the big thing that happens. You usually get the 3-month 10-year inverting in a low growth environment, and it doesn't take much to push a low growth environment into a negative growth environment. And it's these expectations, if you have these expectations that consumers are cutting back, businesses are underinvesting, then businesses will see that that's happening, will see demand dropping and underinvest. So that starts the cycle. Once that cycle starts, consumers will see that the economy is weak and they will increase their precautionary savings, pulling back on consumption even more. So that is a cycle that's difficult to break because it becomes self-fulfilling after a while. The only way to break it, really, is to drop interest rates. And that's usually what the Fed will do, will step in and drop interest rates. But we have inflation right now. So you can't run to prop up one end of your mandate when the other end of your mandate is screaming pain. And when we look at the minutes of the Federal Reserve, they will say in there that the probability of recession is real. We're aware of it, but it doesn't matter. We're not going to budge from our fight for inflation. So there is nothing stopping this positive feedback loop from occurring. Probably more than you wanted to hear, but there it is. FOMC meeting, February 1st, 24 days away. And we have CPI in 4 days. And we'll look at that in a little bit more when we get to some other parts of the video here. Fed balance sheet dropped by $43 billion. Look at that. You've passed that 8 number. We are printing a 7 handle. That's a psychological milestone to hit, right? Under 8 trillion. At a runoff of, well, it's 95 trillion a month, but there aren't enough MBSs that mature each month to get there. So we'll say that you got a runoff of about probably $80 billion a month. You have roughly 960 billion that is going to be rolling off over the course of this year. I don't think that you're going to see a 6 handle on this until 2024. That's if they continue running off the balance sheet for the rest of 2023. Last week it was 8.042 trillion. This is all treasuries, by the way, 41.355 billion in treasuries. The cap on this is 60 billion a month on coupon paying bonds. If they don't have enough coupon paying bonds, they let bills mature and they don't roll those over. The meeting probabilities for rate increase, 25 basis points. And I know the last 2 weeks I've been putting 50 and 75. I think it was just habit. And week after week I just kept copying out the same numbers and I wasn't thinking about it. But the choice is between 25 and 50. We're sitting with a weight of 75% on the 25, up from 67%, and 24% on the 50. If we look over at June 14th, where the range of rates will be 4.75 to 5.75, the weight is on the 5 to the 5.25. Roughly 80% somewhere, either the terminal rate being 5 or 5.25 by June. I picked June because if you look at the Fed funds futures curve, that is basically where the curve is bottoming out, and then the index rises from there, implying that rates, if we go further out, that the distribution of rates would be lower. Effective federal funds rate from New York Fed is 4.33, and we do now have the 30-day pretty much equal to the effective federal funds rate. Efficiency is back. Reverse repo on December 30th jumped to 2.55 trillion, but it always jumps the last day of the month for end of month positioning, and then of course it was all re-released back, 2.2 trillion. Which is negative 345 billion. If you look at the Fed's reverse repo facility, it's been over 2 trillion for a while. If you look at its repo facility, it has been 0 for the longest time, and their repo rate is 4.5%. and the reverse repo is going out at 4.3, which is equivalent to 1-day SOFR rate. Okay, let's have a look at the minutes. I've read the minutes in detail quite a few times now. I'm not going to do that anymore because it does take a long time, and I think I've impressed upon you that there's a lot of good stuff in the minutes. You should read the minutes. We're only going to read page 9, and we're only going to read a few things up to about there, so because there's a lot of good stuff here. Participants generally noted that the uncertainty associated with their economic outlooks was high, and that the risk to the inflation outlook remained tilted to the upside. Now, this is the December meeting. They already saw the November and the December CPI. November was for October and December was for November, but they already were aware of what the numbers were. Participants cited the possibility that price pressures could prove to be more persistent than anticipated due to, for example, the labor market staying tight for longer than anticipated. I'll stop there. So we know the labor market is tight. The JOLTS is telling us that the labor market is tight. Continuing claims is telling us that it's tight. Initial jobless claims is telling us that it's tight. But we are probably, and I think the market is misinterpreting the jobs report. The jobs report was very good. The household survey showed a gain of 717,000, the establishment 200 and some thousand, but a misreading on the average hourly earnings. So we do have a tight labor market, and for those who have the applied series, when we go through the beverage curve, we'll see exactly how tight it happens to be now. Participants saw a number of uncertainties surrounding the outlook for inflation stemming from factors abroad, such as China's relaxation of its zero COVID policies. And over this past week, it's done now. They've removed the rapid testing, removed all of that stuff, off you go. So if you have this built up, this pent up demand in China, as you had in North America when all the COVID restrictions were lifted, what if that causes another surge in inflation, right? So they're paying attention to that. Russia's continuing war against Ukraine and effects of synchronous policy firming by major central banks. A number of participants judged that the risks to the outlook for economic activity were weighted to the downside. They noted that sources of such risks included the potential for more persistent inflation, inducing more restrictive policy responses, the prospect of unexpected negative shocks tipping the economy into a recession in an environment of subdued growth, and the possibility of households and business concerns about the outlook restraining their spending sufficiently to reduce aggregate output. So let's just review those two sentences because we have talked about that. This one over here, the prospect of unexpected negative shocks tipping the economy into a recession in an environment of subdued growth. Remember the explanation for why the inversion of the 3-month to the 10-year typically has such a good record predicting recessions is because it typically happens in low growth environments. And all it takes is a negative shock to push it into less than zero growth, into negative growth territory, but that a high growth economy would be able to absorb that shock. So they are saying that very same thing here. And when we talked about what the inverted yield curve does to change behavior, how it changed the behavior of consumers and how it changes the behavior of businesses, and it's the change in behavior that causes the recession, not the inversion of the curve itself that causes the recession. It says the possibility of households and businesses' concerns about the outlook restraining their spending. All right. In their consideration of appropriate monetary policy actions at this meeting, participants concurred that the committee had made significant progress over the last year in moving towards a sufficiently restrictive stance of monetary policy. That reads dovish. Even so, participants agreed that inflation remained well above the committee's longer-run goal of 2%, while the labor market remained very tight, contributing to upward pressures on wages and prices. So that is more of the hawkish side. So there's a little dove in there, a little hawk in there. Participants continued to anticipate that ongoing increases in the target range for the federal funds rate would be appropriate to achieve the committee's objectives. So you are going to get a rate change in February. The market does not have any probability on zero. It's 25 or 50. Kind of hard to make the case for 50, but they might go 50 to really move it to restrictive sooner than later. And if they go 50, maybe they're thinking, let's front end load the 50 and stop. Or they may say, look, everybody's raising rates. It's happening everywhere. Let's go 25. But they did say over here, China's relaxation of its zero COVID policies could cause a bit of a problem, so why not just go 50? Right now, the weighting is on 25, as we've seen. No participants anticipated that it would be appropriate to begin reducing the federal funds rate target in 2023. Now, this is interesting here. Participants generally observed a restrictive policy stance would need to be maintained until the incoming data provided confidence that inflation was on a sustained downward path to 2%. Whereas over here, they say that it's above its longer range goal of 2%. We've always heard them say it's 2%. It's 2%. But here they're saying a sustained downward path to 2%. So could they, if we see inflation dropping for the next 5 or 6 months, could they begin to cut rates at that point, 25 basis points here and there, because they see it on a sustained path down to 2? Or does it take 2% to begin the cut? Here, it kind of implies as long as they see a sustained downward path to 2. That reads dovish as well. This is super, super interesting. It's new language. This is the first time that they've actually said something like this. Participants, not the yellow part when we get to the pink and the green here, but still, let's read the beginning. You don't start a story with the princess. You start with once upon a time in a land far, far away. Participants reaffirm their strong commitment to returning inflation to the committee's 2% objective. A number of participants emphasized that it would be important to clearly communicate that a slowing in the pace of rate hikes was not an indication of any weakening of the committee's resolve to achieve its price stability goal or a judgment that inflation was already on a persistent downward path. Instead of using one font for a paragraph like that, they really should underline and highlight and italicize some words to add some context to what they're saying so that you can hear them stressing words when they say, it is important to communicate that a slowing in the pace of rates was not an indication of any weakening. But if you just read it all like one font, was not an indication of any weakening of the committee's result. It sounds like, whatever. I'm going to pay attention to the first part. Really, they could bold it, right? Read that pink part. Participants noted that because monetary policy worked importantly through financial markets, an unwarranted easing in financial conditions, especially if driven by a misperception by the public, I wonder who they're talking about there, right? By the public of the committee's reaction function would complicate the committee's efforts to restore price stability. It's kind of like, Darth Vader's threat, I find your lack of faith disturbing. It's just disturbing? It would complicate our job. A misperception by the public. I know who they're talking about. I will throw up the Chicago Fed's the Financial Conditions Index as soon as we're done this, and we'll see what's going on there. Okay, last paragraph here. Participants discussed a number of risk management considerations related to the conduct of monetary policy. Many participants highlighted that the committee needed to continue to balance two risks. Well, that makes sense. You're a dual mandate Fed, so you do have to balance two things, right? Full employment with price stability. One risk was that an insufficiently restrictive monetary policy could cause inflation to remain above the committee's target for longer than anticipated, leading to unanchored inflation expectations and eroding the purchasing power of households, especially for those already facing difficulty making ends meet. The other risk was that the lagged cumulative effect of policy tightening could end up being more restrictive than is necessary to bring down inflation to 2% and lead to an unnecessary reduction in economic activity, potentially placing the largest burdens on the most vulnerable groups of the population. Participants generally indicated that upside risks to the inflation outlook remained a key factor shaping the outlook for policy. Notice which side they're leaning on here. A couple of participants noted that risks to the inflation outlook were becoming more balanced. Participants generally observe that maintaining a restrictive stance for a sustained period until inflation is clearly on a path toward 2% is appropriate from a risk management perspective. So until that is obvious, they're not going to run to prop up the other risk. They're going to stay on this one. However, I will say this, if there is a shock that tips the economy into negative growth, inflation will drop very, very quickly. And if inflation does drop very, very quickly, it will give them permission to run and manage that other risk, which means rate cuts. Okay, so we have seen the National Financial Conditions Index and the adjusted, that's what the A is for here, the adjusted index in past videos, so I'm not going to go over it, but we'll read this a couple of sentences here so that we understand what we're reading. Each constructed to have an average value of 0 and a standard deviation of 1 over a sample period extending back to 1971. So in other words, it is displayed as a standard normal distribution. Positive values of the index have been historically associated with tighter than average financial conditions, while negative values have been historically associated with looser than average financial conditions. Similarly, positive values of the adjusted index have been historically associated with financial conditions that are tighter than would be typically suggested by prevailing macroeconomic conditions. That's what the adjusted is for. It's adjusting for the current economic conditions. Negative values with the opposite. So let's go down. Here's our chart. Here's the index. Here's the index, and here's the adjusted index, which accounts for the current economic conditions. Let's go back 12 months ago, a year ago. Negative, meaning very loose conditions. 6 months ago, let's just worry about the adjusted one, because that's the one that takes into consideration what is also going on in the economy at the same time. It's the more important one. So it's restrictive. 3 months ago, restrictive. 1 month ago, not so restrictive. Previous reading, 1223. Again, look at that, less restrictive. And then 1230, even less restrictive, negative 0.21. Since then, rates have come down. We've seen on the first screen, capital market rates have come down, mortgage rates have come down, equity prices have gone up. Over the last week. The S&P's up, I forget again, 1 point something, 2%, whatever. Well, all of that will make the next reading we have even more negative. Financial conditions are loosening. Remember that paragraph I used different colors for in the minutes, that they were concerned that the public, quote unquote, would misperceive what the Fed was doing and create looser financial conditions, thus, quote, complicating the Fed's reaction function. And that is exactly what's going on if we're looking at this particular index. So if this continues on, the Fed just might come out in February and do 50 points to lay down the law. I don't know. I think that they're going to use Fed speak over the next little while, because we do have Fed speakers coming out. They're going to use Fed speak over the next little while to really hammer home the fact that the more that this happens, the higher they're going to have to go. Okay, let's look at our real rates, and a bit of a story going on here. Look at the 5-year, look at the 10-year. You have an inversion from the 5 to the 10-year on the real rate. When you have an inverted nominal yield curve, let's say the 2 to the 10 is inverted, it could invert due to lowered inflation expectations that would show up further in the cycle. Maybe from the 5 to the 10-year, it would show up there. So you would have an inverted yield curve for nothing more than lowered inflation expectations. If we're trying to tear apart the inversion of the curve to, well, is the market expecting lower growth going forward or lower inflation expectations, then we can look at the real curve versus the nominal curve, and you have an inversion on the real curve happening, which means an expectation. If you look at the 5-year forward rate, which is, I've now added that to the real rates, the 5-year forward, 117. So that, because it's real, that would be reflecting the market's perception of the prospects for real GDP growth, and they're seeing that it's going to be, or at least pricing in, a low growth regime going forward. So not only is inflation expectations coming out, because of the data last week. I think the misread data last week, we're going to see that I think it's highly misread. You can't rely on the numbers from the jobs report to measure wage inflation. That is, it's wrong. But I think that not only is inflation expectations coming down, but there is a growing sentiment that we are probably going to enter with interest rates high for an extended period of time, an underinvestment period, and a low growth period. Well, that will pull back investment even more, thereby creating a stronger catalyst for a recession. So we're going to keep watching this, but you have a 151 to a 134 with the 5-year forward at 1.17. Inflation expectations have all pulled back, which basically the rally last week was based on that whole idea. Some of the ISM numbers that we saw for prices paid are below 50. And when we looked at average hourly earnings, growth year over year came in below expectations and got misread. I'm going to demonstrate that it was misread. So it came out of the curve as well. I think that as cooler minds review the jobs data over the weekend and tear it apart, they will come back Monday by saying, whoops, we misread that altogether. And up, I think these inflation expectations will go. Let's go over to the Fed funds term structure here. Last week, May, June, July, the index roughly around 95.03 across all three, in and around 95.03, which implied a rate of 4.97. So a target range somewhere between 4.75 and 5.25. It's hard to say it's 4.75 to 5 when it's bumping up against the 5. Well, pull back a little bit this week, down 2 basis points, 4.95. Still May, June, and July, with June sort of being the bottom, which is why on the previous screen when I looked at the distribution of terminal rates, I picked June because it's the bottom of the index curve here. December sitting at 95.43, implying a rate of 4.57. Last week, December was at 4.645. So you actually have an increase in the index, meaning a decrease in the terminal rate at the end of 2023. If we look at the 1 year forward minus the 1 year rate, we have a negative 94 basis points, so that we would anticipate in 1 year. And the forward curve tends to overestimate the future spot curve, typically tends to overestimate it, but 94 basis points, so that sometime over the next 2 years, it's pricing in about 100 basis points worth of cuts. I say over the next 2 years because this is a 1 year forward rate. It's what the 1 year would be. Monetary policy finds its way into the 1 year rate. So the 1 year rate doesn't have a lot of effect in there other than the effect of monetary policy. So if we're looking at the 1 year forward rate, it should reflect monetary policy in 1 year, sitting at 3.77, which is 94 basis points below where we are. Whether that reflects cuts between now and next year or anticipated cuts over the following year, it's hard to pull that one apart. How you get the 1 year forward is you take the 2 year rate and you square it and you divide it by the 1 year rate. You add, it's 1.0424, you got to add 1 to it before you do it, and then you subtract out the 1, you'll get 3.77%. Let's look at TLT. Actually, let me just say, why do I look at this and what does it mean? It gives us some idea of what the market is expecting so that we can determine whether or not we agree with the market. We can listen to what the Fed says and we can look at what the market is saying. And I will show you a line in the minutes where they say that no participant is anticipating any kind of cut in 2023. Is the market fighting the Fed by doing this? It would seem no, because why would you fight the Fed in that particular case when it comes to, when they're clearly saying something, and I think they've made their point now. In the summer, there was some misunderstanding and the market was openly fighting the Fed. I don't think they're doing that right now. I think they believe the Fed. I think they believe that the Fed is not going to cut rates in 2023. But I think they also believe that a recession is going to show up, and it's not a matter of resolve anymore. It's that, well, they're going to have to take care of the other side of their mandate. So this is, to me, suggesting that there is, in the latter half of the year, some kind of recessionary pressure that is building in there. Let's look at our TLT trade. Things, whenever you take a position in something, you should never ever take a full position. And I know that markets move fast now, and you think, well, I need to take a full position because markets simply just move. But and I've complained about that before, that I barely get my initial position and the market just moves. Still, I follow my rules because you want to avoid two emotions. You want to avoid greed, and you want to avoid fear. Greed will make you take a full position on day one. If you have a full position and it moves against you, fear takes over and you need to get out. Oh, that's it. What a terrible decision. This guy doesn't know what he's talking about. I'm out, and you lose money. If you build into positions and it moves against you, if you avoid greed, you avoid fear. You have no fear. So the TLT trade at the end of last week did not look good at all. Closed below $100. Week over week, the trade is now up 5.64% week over week, and the SPY is only up 1.86%. And implied volatility on this trade really dropped as well. So, when you see the implied volatility increase, there's where you should start to get a little bit more excited, right? Volatility always overstates the volatility of the fundamentals. So whenever you see implied volatility rise, it's typically always wrong, that the underlying will not experience that kind of volatility. It's typically always wrong. So it's, if you're sizing your trades such that you don't get fearful, the market really truly is a money printing machine. So it closed January 20. I closed. It closed. I'm going to tell you about my positions here. I was short the January 23 102.50 puts. I closed them at $1. Only to watch them go to like 70 cents by the end of the day, because I thought, well, how long can this rally last? So I closed them at $1, so I got $1.35 off the average price of my options. But my ZBs, remember, I was long the bond futures. I added bond futures. So as TLT was pulling back, the 30-year bond was dropping as well. So rather than do another TLT trade, I went long the bond for some duration. I got 4 points out of that. Each point is $1,000, so every contract paid off by $4,000. Since I'm long 40 long calls, that's the equivalent of 4,000 shares. $4,000 per contract on what I have was the equivalent of $1 per contract. So I got $1.35 on the options, plus another $1 on the on ZB, because I consider this one trade still. I consider this all the duration trade. So I did get my average cost down by $2.35, which was the price of the options anyway. So with the combination of long futures and the options, my long options now, which were 650 and 715, dropped by $2.35 each. And I got that all in 1 month. That was greedy. I got greedy. I don't plan to get that greedy every single time, but I'll tell you something, if TLT takes another dip downwards, I will get greedy again. When volatility spikes, that's the time to get greedy. When volatility drops, that's the time to sort of, start thinking about getting a little bit more conservative. So that was nice. So now my goal basically is to make these calls free. And once they're free, I have absolutely no fear of the trade not working out. No fear at all. Why? Because I'm money neutral. I got them for free. Somebody asked me about the tax hit on this. There is no tax hit on this because these are capital gains. And if this trade doesn't pay off, these are all capital losses. So they cancel each other out. So I just have to get money neutral before tax. I don't have to get money neutral after tax. Okay, let's look at the credits. OAS, nothing. I mean, if you sat and waited for a basis point movement paint would dry faster. Nothing going on there at all. In the mortgage market, the 30-year is 6.48, but this is as of the 5th. It doesn't reflect the 6th. So I went to Mortgage News Daily because since they look at actual rates as opposed to a survey, they can do it day by day. Just on January 6th alone, the mortgage rate dropped 30 basis points to 6.2. So if I took 30 basis points off of here, I get to 6.18. It's fairly close since the market survey was changed to be closer to more observed rates than asking what rate do you have, but actually observing rates. These two sort of gotten close together. So that's not bad. A mortgage rate that's low sixes. I think you'll probably see fives at some point this year. I think you'll see a 5 handle before you'll see a 7 handle again. This I can't make sense of here. For December 30th, mortgage applications, the reported drop was 10.3%. But when you look at each of the indexes, the refinance index and the purchase index, and do the calculations, I can't seem to square that. Because each of these will be weighted, W1 minus W, it has to add up to 100%. I don't know how you get down to 10.3 from a 16 and a 12. So I checked the numbers again, and yeah, they were the numbers. I was dividing the right numbers to get there. So there must be an error in the reporting somewhere, because when I look at the mortgage market index, it is down by more than 10.3. It's like 14 and change, which would square with these numbers. So I think that there was a misreporting of the mortgage apps being down. Home builders. Let's have a look at these guys. And I know this is a hard chart to follow, but you see this line at the very top over here. This is the outperformer. This is a 1-year chart, and you see how prices went down, and then in the last quarter they've started to go up. Over the last 90 days or so. Well, I have 3 months here. This top line is D.R. Horton all the way through, outperforming. And you can see how well it's done. And look at the last 3 months. DHI is up 28.9%. Lennar's up 20%. KB Homes up 22.4%. This is just the last 3 months, while the S&P is only up 3.39%. Look at that outperformance over the last 3 months. And even over the course of the year, I know this is hard to read, but I'll read them for you. SPY, as of the time of doing this on a 1 year, this is a trailing 1 year, is down 15.8%. D.R. Horton is only down 8.13%, which is the largest home builder in the U.S. Second is Lennar, they're down 12%. So -8, -12, almost 16%. Toll Brothers is down 22, but Toll Brothers is really high-end homes. They're not anywhere near the size of D.R. Horton and Lennar. Pulte down 12.69, kind of in line with Lennar. KB Homes down 18, and NVR, super high-priced, not overvalued, but just a when you look at the price, you go, come on, man, like do something, do a split or something. Down 16%. But huge outperformance all year long. D.R. Horton has an all-time high, post-pandemic all-time high, by the way, of 109.95. And they're sitting at 92 and change right now. I just don't know how much more upside there is, because they've had such an incredible run over the last 3 months, up 29%, that I think they're sort of due either for some sideways motion or a pullback. So this is the point at which I would get more aggressive on my home builder positions by selling calls. I'm not bearish on the home builders. It's just how much more can you price in, right? Until I get more clarity on the economy, and all the signs, economic signs, are pointing to a recession right now. That in a recession, they're not going to grow into the recession. They may go sideways or down slightly, but enough is enough. It was a good run, 28.9%. You stay in that longer, that's just called getting greedy. So yes, I do have three home builders, and I have the XHB. I have sold calls on XHB. And if they stay at these levels, they will be called away, which I'm comfortable with. But I will be selling more calls. I have sold some calls on these, but I will be selling more calls on them because this kind of outperformance, I think all the excitement of the home builders and the idea of low inventory, I think that's all priced in now. I don't know that you're going to continue to get gains at this level that we've been getting. Okay, let's move over to jobs and PMIs right now. We're going to look at two sides of the equation: employment and production or output. Earlier in the week, we've got the JOLTS report, openings and quits. Openings actually increased to 10.458 million. Quits still elevated above 4 million. In fact, the quits rate has actually increased. If you have access to the applied series, there is some extras for this particular week that will be up on Monday. We'll go through the beverage curve, and I will map that to changes in the participation rate and some of the fiscal policies that occurred over time, and we'll look at the beverage curve pre-pandemic, pandemic, post-pandemic, and see what it has to say. It's really interesting stuff, and it aligns well with some other data. Later we got initial claims, 204. That's down 19K from the previous week. There was some thinking that after the Christmas rush there were going to be significant layoffs, but nope, they actually dropped. And continuing jobless claims dropped by 24,000 down to 1694. Let's do some of the PMIs before we get to December non-farm payrolls, because there's quite a bit to unpack here. What I've done down here, any red arrow is bad news, any green arrow is good news. So let's look at the good news. ISM manufacturing employment, 51.4 from 48.4. That means companies that are anticipating adding to their employee count in a tight job market. Well, that's good news for jobs, right? Up it goes, but bad news for rates and bad news for stocks if we think rates are going up because of that. Prices paid, though, 39.4. Previous was 43. It was expected to drop to 42.6. Now, this is for December. Prices paid. And if we look down here at ISM non-manufacturing prices for December, 67.6 down from 70. So it has given way, and same with manufacturing has given way. Kind of a look ahead into CPI, and if you misread average hourly earnings, they were only up 0.3 or 0.27, 3.35% annualized or 4.6% year over year, which was lower than expected as well. But this is not wage inflation. This is not wage inflation, so you can't read it that way. But the market did. So perhaps Thursday's CPI will reflect these prices paid actually dropping. So there's the good news, is that you still have a tight labor market, and companies still want to hire more. Maybe not a recession going forward, and you have prices that are coming down. The bad news here is if you look at S&P Global Manufacturing, 46.2 versus 47.7. ISM, 48.4 versus 49, more contraction. New orders, 45.2 versus 47.2 last time, so new orders are down as well. What else do we have? The composite, 45 versus 46.4. Services from S&P, 44.7 versus 46.2. The ISM tends to be the one that gets more attention. 49.6 versus 56.5. That is a huge drop from November to December. Factory orders, which isn't part of ISM, but it's in there, negative 1.8%. This is what I mean. This is investment, by the way. That is investment, and you can see that is negative, and that affects the component of GDP. And investment is the most volatile component of GDP. Non-manufacturing employment for here, 49.8 versus 51.5, which is showing in the services sector some kind of wage or employment slack starting to show up. This is ISM manufacturing, which is in the goods producing sector. So we're seeing employment prospects increasing in the goods producing sector, but decreasing in the services producing sector. What do we have here? Business activity 54.7 versus 64.7. Big drop down. New orders 45.2 versus 56. That's a huge drop down. Let's move over here on farm payrolls, and then we'll dive into that a little bit deeper. Reported 223,000. That is from the establishment survey. The household survey was over 700,000 increase. Right? Interesting. Unemployment rate now 3.5%. This is where the market threw a party, and it was the wrong party to throw. I'll explain why. Let's say that an economy can add 100,000 jobs. It can add high wage jobs or low wage jobs. And when we say high wage, here's the average wage. It means above the average wage and below the average wage. And let's say that when it hires 100,000 high wage employees, there is 0% job growth year over year. However, when it hires the low wage employees, there is 10% job growth. What's going to happen to average hourly earnings if you hire the low wage 100,000 low wage workers? Average hourly earnings will decrease. If you hire the high wage workers, average hourly earnings will increase, because average hourly earnings is concerned about the mix of jobs, not the rate of change of pay of those jobs. To capture this effect, you would have to look at the employment cost index, which looks at a job and measures the change in wage for a particular job over time. But if you change the mix of people being hired, you can make average hourly earnings go up or down depending on who you hire. So let's have a look. We're going to make a few assumptions here. We're going to assume that if you have more education, you tend to get hired at higher pay. We're also going to make the assumption that if you're older, you tend to get higher pay, because being older is correlated with more education. It's also correlated with more experience. So let's have a look. If you have less than high school, there was a loss of 63,000 jobs. If you have only high school, there was a gain of 523,000 jobs, and this is for people 25 years or older, so I've broken down the 20 to 24 here. If you have more than high school, so you have some college but you didn't finish college, there was a loss of 13,000, and if you finish college, a BA or higher, a gain of 166. Where's the big gain? Right here. You've got some high school you're finished high school, but you have no college education. In other words, you don't have more than high school, just high school. And if we look at the 20 to 24, there was a gain of 75,000 jobs there. Now, these don't add up to the 717 because there is still the 16 to 20 age group, and we don't assume that they have high school. So we assume they have less than high school. They're not even counted. This over here, these numbers here are all the 25 plus. So when you look at the mix, it came from high school, and it came a lot from lower aged workers, which tend to be paid less. So it's not so much that wage inflation decreased, but the mix of jobs skewed towards the lower income wages. If we look at the average weekly earnings, it dropped by 0.01%, basically flat. Why? Because weekly hours went from 34.4 to 34.3. So when you combine the two together, you basically have zero growth in aggregate, I shouldn't call it aggregate incomes, but employment incomes. Your participation rate went from 62.2 to 62.3. We're going to look at table A9, because another important part is full-time versus part-time. We would assume that full-time workers per hour make more money than part-time workers per hour, because part-time, well, you get paid less and you don't get benefits, but with full-time you get all of that. So we would assume that if the jobs came from full-time jobs, well, then they would be paid more. If they came from part-time jobs, they would be paid less. And again, that's part of the mix of the employment. So we're going to see that this decrease here is purely a result of the mix of jobs, and we can't say anything about wage inflation at all. But we can surmise that wage inflation is still going to be very high. The employment cost index will be elevated. This is all these numbers, by the way, are seasonally adjusted. the household survey, there it is, December, showed an increase of 717,000. If we look at 2022 on the household survey, there was a creation of 3.163 million jobs. There was some discussion that jobs were being overstated. The Philly Fed had said, no, you're overstating jobs by about 1 million. But no other evidence in the job market, when you look at JOLTS, when you look at the quits rate, when you look at wage inflation, no other piece of evidence suggests that that's going on at all. So let's sum up this page here. We have contraction based on the PMIs in goods and services for December. You have 0% growth in employment income at the level of the economy for December. Well, if everybody is walking home with 0% growth month over month, where's the extra demand going to come from, right? If we look at earnings, the earnings forecast for December, for Q4 of 2022, Q4 is expecting a negative 2.2% growth in corporate profits. If you exclude energy, negative 6.7% growth. So what do we have going on? You have contraction in the goods sector. You have contraction in the services sector. You have an extremely tight labor market still. Initial jobless claims are low. Continuing jobless claims are dropping. But you have a skew of jobs going to the less educated and the younger workers. And we're going to see that it's primarily all, well, I shouldn't say primarily, it's all part-time, by the way. It's all, the gains were all in part-time. And this is being misread. That this decrease that we saw, that we threw a party for, is because the mix has changed to a less desirable mix as opposed to showing true disinflation going on in wages. Let's go look at table A9. Okay, let's start with household data, table B. This is nice, end of the year 2022. They give you every single month. Have a look at this row right here for employed. Let's read across. Remember this number, 159,244, 159,244,000 employed. Because when we get to the part-time and full-time, it has to add up to 159,244. How full-time is done, or part-time, it's done on what's called a full-time equivalent. So average weekly hours is 34.3. So if somebody worked, let's say you find two people who work part-time for 17 hours each, well, that doesn't count as two. That's a one full-time equivalent, even though it's two part-time workers. So if it says there are 20 million part-time workers, it means part-time workers, if you add them all up and normalize them for, well, how many full-time jobs does all of that add up to? It's reported as a full-time equivalent. Okay, let's go down to A9 just so that we have that in mind, and we'll see I can just scroll till I see my yellow printing. There it is. Okay, so we've already been through high school, less in high school, and we've been through the younger years. We've seen that the jobs have skewed towards high school and the 20 to 24. There were gains there. Yes, there were gains for BA, but the big share of the gains were for the less educated and the younger. Have a look at this, full or part-time status. Full-time workers. Last month, 130, or for November was 132.3. For December is 132.299. Actually dropped by 1,000. Have a look at part-time workers. This is full-time equivalents now. 26,115 up to 26,794. Some 600 and what does that come to? 679,000 of the 717. 679,000 based on these numbers here are for part-time workers. All of those jobs were made up of part-time workers. In fact, full-time workers lost 1,000 jobs from November to December, and part-time workers made up the difference. Lower educated people earn less, younger people earn less, and part-time workers earn less. And all of the job gains came from those categories. I shouldn't say all, but pretty much the dominant share of it came from those job categories. Is it any wonder that average hourly earnings dropped? But average hourly earnings is not wage inflation. It is the mix of jobs in the economy. Multiple job holders, 8,046,000, which is why these numbers, if you add these two numbers up, they add up to the total amount of employment, but not the total amount of jobs. You have to go into the self-employment, the difference between the self-employment and the multiple job holders as well to get to the 717. But I need to point that out. Once you start diving into the mix, you find that, well, that doesn't tell us anything. I mean, if I hire a bunch of high school students who are 24 and I hire them all part-time, yeah, that's going to cost me a lot less than if I hired full-time workers who had some college or college experience and were 45. Yeah, I mean, obviously that's going to cost me less. But maybe I'm hiring them because I need to lower my wage costs somehow, and moving into part-time positions allows me to get that done. Another interesting thing here, let's move up here. Typically when you head into recessions, companies tend to, they don't cut employment first. They tend, let's see if I can find the one that I'm looking for here. I need the institution, not the household data, but the establishment data. Let's keep going here. Bear with me. I'll get it. I know what I'm doing. Or have I gone too far? Hang on. Let me go back up here. Let's see what we can find here. There's your employed. There's household data. There's establishment. Okay. When companies are going into a recession, what they tend to do is they'll cut overtime hours first, and they'll let go of temporary workers before they start cutting their own staff. So if we look down here for where they are temporary help services, let's read across here, negative 35,000. That seems consistent with everything else. You know, if we were trying to build a story that companies were using cheaper labor by using more part-time workers than full-time workers, by cutting back on the average hours worked per week, because we did see that drop back, releasing some full-time workers, hiring younger people, those kind of things. The drop in temporary help services does make sense, and you've seen that going on for 3 months now and accelerating, negative 22, negative 30, negative 35. So, just a little bit of evidence there. Okay, before I render this video, I thought I'd insert one more little clip after I had done the video as I was enjoying my morning coffee. I like this channel, by the way. I'll give you a link to this particular channel. It's from Princeton, and he interviews a lot of good academics with a lot of good research. And I watched this one, I thought, no way, it's exactly what I was talking about, the unexpected competition at work in the low-wage economy. We don't have to go through the video. I have the presentation here. I'll give you a link to the presentation. It's really long. It's 113 pages. But there's just some screens that I want to show you, and the slides are really small, so let me just see if I can increase the size of them here so that you can see them. And let's just get to some interesting charts here. That are really interesting. Let's see, where are we? Employment losses. That's not what I'm looking for. Oh yeah, hang on. This one here. This is employment losses and the rebound. And the red dots here, this is high school, green is some college, and blue is BA. You can see that BA is sort of just going sideways. It was slightly trending upwards pre-pandemic, and it is recovered, and it's following its typical pattern. But you can see that the big job gains are coming from high school and some college, from the lower skilled workers. And if we're looking for low, mid, and high wage occupations, the red line is low wage occupations. They have, look how quickly they've come up, and they are now above both the green line and the blue line. This is really interesting, super interesting stuff here. So this is a 36-month change. This is 24 months, and this is 12 months. And what we have along the bottom is hourly earnings percentile. Over here at 100%, this over here represents the top hourly earners. And down here is the lowest hourly earners, and here is CPI inflation. And here again, this is 24-month change, and this is the last 12 months. So you can see that CPI has increased in each of the months. If you're above CPI, your real wage is increasing. So over a 3-year change, even taking the 3-year average CPI into account, looks like about the bottom 70% of wage earners saw their real incomes increase. Over the last 2 years, it's been the bottom 20% that have had real wage increases. And if you take over the last 12 months with the massive inflation that we've seen over the last 12 months, it looks about 18%. The bottom 18% of earners have seen real wage increases. Well, that's all good. If you adjust for regional differences, because this is at the aggregate level, but to say that, somebody who's making $30 an hour in West Virginia may be a very good wage. It may be in the 70 or 75th percentile. However, if you're doing that in California, you might be in the 20th or 30th percentile. So if you adjust for the regional differences to put everybody in their proper percentiles, this is what you have. So here, by adjusting for regional differences, this is regional differences in average hourly earnings and regional differences in state-to-state inflation. Look at this. The bottom, roughly 90% over the last 3 years have had real wage gains. If you take it over the last 2 years, we're trying, the last one here isolates just the period of the big inflation that we saw. Last 2 years, roughly about the 30% here, the bottom 30 percentile saw real wage gains, and you're still right around 30% here if you take in the last year as well. In fact, it is the top earners, the top 20% to 30% that have seen real wage decreases, that their real earnings have actually gone down, and the bottoms, real wages, have actually gone up. They're the ones with the highest marginal propensity to consume, and they have more real purchasing power because of that, which, adds to demand pressure. And then there's a whole bunch of interesting stuff here. Real wage trends by quartiles. This is the 10th percentile, the 50th, and the 90th. Look at what's going on here. This is real wage gains. For the 10th percentile, look at the 90th percentile, straight down, and it follows that pattern down. If you look at states that had minimum wage with no minimum wage post-pandemic, you're pretty much getting the same effect. What they were showing here was, the title of this was the idea about wage compression. And if you look back to 2015, you could see the disparity between the 10th percentile way down here. This is the hourly wage way down here, the 50th percentile, and the 90th percentile. So you had a lot of dispersion in these wages. A naive way of saying it is you had inequality. Well, we don't know if it's unequal. First of all, let me change that. We do know it's unequal. We don't know whether the inequality is fair or unfair. A brain surgeon is going to make more than a McDonald's worker. That's income inequality, but it's a perfectly fair inequality. So there is inequality here. The question is it fair or not is not part of this analysis, but there is inequality. This is but look at what happens as you head to 2019. You get compression, where they're all in around the same coefficients here. When you see something like that, you should see wage inflation. You should see wage pressure. And we can only measure that with the employment cost index. We have to look at the ECI over the period of 2015 to 2020 to see whether or not we were already experiencing wage inflation. So let's edit our graph here. Let's go down here and let's say percentage change from a year ago. And let's look for 2015 roughly. We're pretty much sideways here. 2015's in here. And to 2020, did we see it move up? Yes, we did. We were already seeing the employment cost index moving up before the pandemic occurred. The employment cost index was moving up. The 3-month to the 10-year was already inverted at that period of time, and all the economic indicators were pointing at a slowdown. Which is fairly typical. Whenever you have the employment cost index rising to a certain level, it ends up causing a recession because employers just start trying to substitute as much as they can capital for labor because labor costs are rising too much. So we were already seeing this going on. What is going on from 2010? If we look at the participation rate from 2010 onwards, is the participation rate has been dropping. The baby boomer generation is 1945 to 1965. If you were born in 1945, you were 65 in 2010. So there's a 20-year great retirement period from 2010 to 2030. What is making the participation rate drop specifically is that the generation coming in is smaller than the generation leaving. So that means those people who are turning of working age today are fewer than those who are turning of retirement age today. And every single day from January 1st, 2010, based on the size of the boomer generation over 20 years, every single day, 10,000 people retire, 300,000 people a month, but you don't have 300,000 people a month turning of working age. So you have a participation rate that is shrinking. And if you have a participation rate that is shrinking, what we should see is an employment cost index that is increasing over time, and that is what we have. So I've got this link for the YouTube video in the description box. I've got this link for the presentation in the description box below. And you can always go to Fred and look at the employment cost index on your own. Okay, let's move on to the VIX. And we can see here for SPX the implied volatility, because our VIX has dropped 21.11 from 21.72. We do see that in the implied volatilities. All of them week over week have dropped. They was 17 down to 13, 21 down to 18, 27 down to 22 for the 52, the 26, and the 13-week implied volatility percentiles. If we look at our futures curve, we can see a huge drop right across the curve. Now, these are expectations. These are not no arb prices. So if you have been through futures pricing before, you know that a futures price is called a no arbitrage price because it takes the spot price and simply carries it at the cost of carry. So that if you borrowed money, bought the underlying, and waited to expiration, sold the underlying and paid back the loan that you've got, that should equal the futures price. If it wasn't, there's a chance for arbitrage. Well, there's no underlying here. You can't be delivered implied volatility. So these truly are expectations, and they are not no arb pricing. I know that's a double negative. They are not no arb. So the expectation going out on the curve, this is February, March, April, May, June, July, is everyone is, or well, at least the market on whole in aggregate is anticipating a continual drop in volatility. You can play this if you want. You can say, well, okay, you know, I expect a drop in volatility as well. The long-term average is 19.1. So if you think that, let's say, VIX at July is 25.3, that it could mean revert to its long-term average of 19.1, you can short it, but the short margin is huge. It's huge because there is no deliverable, and if you get a spike in volatility, that spikes overnight, you could be wiped out. So the margin that's required is almost the full value. So for instance, this is 25.3 times 1,000. So it's in other words, it pays off 1,000 times the change. So the notional here is 25,300. That's pretty much the margin. I mean, it's basically there's no leverage in these contracts at all. You're basically deleveraging these contracts down to zero because the margin is so high. So it's not really a desirable thing to play. That if you're thinking of playing volatility, you might want to play it through the options on the index as opposed to trying to play it with the VIX futures. Long-term average on the VIX 19.1. Here's something interesting. SPX, the long-term volatility here is 15.3. So the VIX tends to overstate, the implied volatility tends to overstate the actual volatility of the SPX, and the actual volatility of the SPX always overstates the volatility of the fundamentals. So if you understand that hierarchy, when you see implied volatility spike, like here, it tends to overstate what actual volatility will do, and actual volatility overstates what the fundamentals will actually do. And if that's the case, you have massive estimation of the volatility and fundamentals. It's just not going to be that bad. That is a huge signal to buy. That's why spikes in volatility are such buying opportunities, because they massively overstate what the change in the fundamentals are going to be. You have a 16.53. I just drew a line back here over this cluster from July of 2021. I don't know that we get back to 16.53 quickly. Usually at very high levels, the VIX tends to mean revert very quickly, but then it starts to, in midterm, it shows some persistence over time. I had printed under 20 for a brief time in December, but then came back up. So far, it looks like it's holding above 20. Forecasting this is the same as forecasting what you expect to happen in the market. For the volatility to spike, there has to be a level of fear that comes in. Hard to predict that, but the volatility index right now is not suggesting that there's very much fear. Your 50-day moving average is sitting at 2263, just above here. The 50 days below the 200-day, which is bearish. Bearish meaning the VIX heading down. 200-day moving average is 25.49. Okay, big story last week in the auto sector continues to be Tesla. So here are the prices of the closing prices. Ford closed at $12.60, GM closed at $35.90, Tesla closed at $113.68. For Ford, I had sold January $12 puts and January $11 puts. I was looking to roll the 11s over to February. There's no real pickup in premium, so I'm just going to let them expire. GM, I had sold puts all the way down. I'd sold 36 puts. It kept dropping. I sold 35.50s, 35s, 34.50s, 34s, laddered, just kept laddering it all the way down. So as it was dropping, I was selling puts on the way down. As it started to increase, I was closing my puts from the bottom of the ladder upwards. So I've closed from 33 all the way up to 34.50. I got the 35s, 35.50s, and 36s open. And I was closing them at good profits. I mean, you're closing them at 20 cents to 30 cents each, and you were selling them at $1.50. So again, GM being a nice income generating machine just with the options, it doesn't have to go anywhere. It just has to keep trading in a range, and as long as it keeps its volatility above 30%, it's just nice to keep selling these premiums on the way down and on the way up. If you're owning the shares, selling calls on the way up. Over the course of the week, Ford's up 9%, GM's up 6.65%, Tesla down another 7.19% over the week. I had bought Tesla and immediately sold a strangle on this. A covered short strangle is the position that I have. So if you have the applied series, I will keep you updated on how I'm rolling down and forward on the options. My goal is to get Tesla for free, is to use the options and the premium on the options and roll with the price to get, and you can do that well with a short strangle. There's always risk in everything you do, okay? So if you look at it and say, oh, but what if it does this, what if it does that? Yeah, that's called risk. I'm looking for the return, and every time you look for return, there's always going to be risk. So in anything that I do, you could say, well, what if it went down? Yeah, well, that's risk. That's the other side of the distribution, right? So you have a return distribution that looks like this. There's your return. Here's your risk. There's always risk. If you try to cut off your risk, you'll cut off your return. If you want no risk, buy a T-bill, right? So I'll show you how I've rolled down and forward. So I've gotten my average price down by about 14 bucks, and I've moved my strike prices for my options down to from a straddle to a strangle now, and I've moved them into February, and a nice pickup in premium because Tesla had some volatility this week, had an increase in volatility, so the premiums were just really nice. Average vehicle sales came in. Vehicle sales came in for 2022. The average vehicle price in December, 46,382. That is not cheap. U.S. auto sales for 2022 came in at 13.7 million. That is down 8% over 2021. However, GM was up 2% in terms of new car sales. By the way, this 13.7 is the lowest since 2011. The auto industry is already running just barely above recessionary levels at this point. When you think pre-pandemic, you were about 17 to 18 million cars a year. You're down to 13.7 million. Edmunds expects 2023 new car sales to come in at 14.8 million, so an increase from the 13.7. And as long as supplies remain tight over the course of the year, and you don't have a price war, profitability for the auto company should be robust. Although I don't see it increasing very much from these levels. I don't see a bull market in new car sales happening. I see a bull market in pricing for new cars because volume will be low, but I don't see a bull market in quantity, just in price. So upside in margins, I don't know that you're going to get a lot of growth year over year in profitability for Ford or GM. So why would I continue to buy them? Well, I don't buy them because I think there's upside. I buy them so that I can have a lower risk options play on them, and it's the options on which I make the money. This on Friday, I think, is probably going to reverse. So here is the open, because they lowered prices another 13.5% in China. It's not overnight. For us, it's overnight. It was during the day in China, but it happened overnight for us. Another price cut up to 13.5%. So it opened lower, but then rumors started going around that all these Tesla locations were being flooded with people. And it's like, oh my God, this is fantastic. See, the price cuts are going to be made up with volume. So rumors of crowding Tesla stores in China, but they were not customers. They were protesters. Because of the $7,500 discount they gave the week before, and plus another big discount they gave here, people who bought Teslas 2, 3, 4 weeks ago starting to show up at the stores going, come on, man, you got to give me some of my money back. They were going in to demand partial refunds for the vehicles that they bought. They were not going in to buy more vehicles. They were protesters, not customers. And that didn't really come through very well in the news feed. All that came through were rumors of Tesla stores and being crowded, and the Chinese website for Tesla went down because of too much traffic. So it was like, oh, they're selling out again. No, it was people complaining. And more stories of that have come out over the weekend. I read the stories from a couple of different sources talking about this thing going on in China, of people showing up saying, okay, this is unfair. I bought a Tesla here, and overnight you cut the price. You got to get whatever I paid here, you got to give it to me. Same if I bought here, I bought here. If you buy on a Tuesday and then on a Friday the price drops $6,000, you telling me you're not going to go back to the dealership and say, come on. For 2 days, you knew what you were going to do. Well, that's what that is over here. So I don't anticipate that this bounce is going to survive for Tesla. I think, longer term, it's still going to find a home somewhere. Probably, I'll say midterm. Midterm, I think it'll find a home somewhere between $65 and $75, which would give it a higher multiple than the rest of the industry, but a more realistic EBIT margin. Because you can't drop your prices like this and not affect your margins. Margins are gone. Let's just say that. The margins, those big 30 point margins it had in Q1 of 22. And I'm adjusting for the credits that it gets. It's 30 point EBIT margin without the credits. That's gone. That's history. Okay, let's have a look at the dollar. And in looking at the dollar, we're going to look at gold. And in looking at gold, it seems like it wants to break out, and everyone's talking about gold, and they're missing a bigger story. If you have the applied series, I'll show you the effect that it's been having on the miners. We'll look at a couple of ETFs that track a couple of different metals, and we'll see that, yeah, gold is responding, but everything else is responding a lot better. That gold is massively underperforming some other things that are related to the US dollar as well. So we've had the dollar significantly roll over. I've taken a line here and I've drawn it for the last 6 months, and this over here I've expanded in this little box down here. So you can see the overlay of this little thing here is this, and this is meant to match this 6-month chart for GC, which is gold futures. Have a look at this particular chart, and you can see it's the inverse of the one that we see over here. So you have, a couple of bottoms over here, which matches the tops going on over here. You have 1, 2, 3 little spikes over here at the top in the dollar. 1, 2, 3 bottoms in gold. You have this roll over here, and you have this going on with gold. It's really tracking the US dollar very closely. We have the US dollar down at 103.88. You can't really see on this side, but there's a big move down, and you have a breakout over a double top on gold. And there's a lot of discussion that gold is simply going to continue to run. And gold is, if you look at over a 6-month period, gold is up. However, copper is up significantly more than gold over the last 6 months. Everyone wants to look at gold. But if you look at copper, copper is outperformed. And if you look at the miners, you can look at gold miners and you look at copper miners. You look at gold ETFs, you look at copper ETFs. There's no comparison between them. Copper is by far the bigger winner. By far the bigger winner. As far as where the dollar is going to go, your next line of support, if you want to think technically here, is right around 100. We're at 103.88, below the 50, below the 200. So I don't know that there's much that you're going to get from those moving averages, because they're to the upside. The 50 is below the 200-day moving average. That is called a death cross, which is bearish. To the downside. The dollar is going to be driven by interest rate differentials. If we think in terms of nominal interest rate differentials, you can break it down into real interest rate differentials and inflation differentials. And in the US, what we saw last week was real rates drop, and we have an inversion of the real curve. Inflation expectations have dropped, and we have an inversion of the nominal curve. While other central banks are earlier in their hiking cycle, they're expected to continue. The Fed is, near that top of the cycle where maybe they're going to turn over, which this, by the way, that I drew out, remember the Fed funds curve looks like this. This is just the inverse of the Fed funds curve. This is the 100 minus R. This would just be R. So the U.S. is almost near the top, whereas others are still increasing. So the pressure to the dollar right now appears to be the downside in the near term. And if that's the case, gold, being that it's priced in US dollars, you need more ounces of gold for each, or more grams of gold per dollar. It will push up the price. So lots of energy and eyeballs are being spent looking at gold. Meanwhile, copper has been the standout by a mile. And even if you're looking at gold, if you looked at the gold miners, you would do a lot better than just looking at gold. Why you want to look at gold when you can, when it's massively underperforming everything else? I don't know. I don't know the fascination with gold. By the way, why everybody thinks, oh, you got to own gold. No, you got to own copper. So if you do have the applied series, I have put an extra screen in there looking at some of those returns over the last 6 months. Okay, let's look at SPY. When we're done this screen, we'll look at this week in earnings because it is now reset for Q4. So Q3 is now over, Q4 is up, so it's got some forecast for Q4. We'll look at what's reporting earnings this week, and nothing till Friday morning, and it's pretty much all banks, big banks too. So Friday morning, from an earnings perspective, is big risk. Thursday morning, from an economy perspective, is CPI. The forward four-quarter EPS is now 228. That's because Q4 of 2022 has fallen off and Q4 of 2023 is now on because it's the forward four quarters. Since we're in Q4 2022 earnings season now, it's not part of the forward. It is happening now. SPX closed at 38.95, gives us a 17 times forward earnings based on 2023 earnings. And this green line on the chart lets you know that I am long underlying shares of SPY. Down around 383. In SPY finished around close to 388, so those are $5 good at this point. I did get my short on ES at 39.50. I had to wait all week long. I waited for 39.50. It didn't happen. I kept seeing it go up 39.20, 22, then all the way down to 38.70, 38.60. I thought, oh, come on, man. Every time I missed it. But I did finally get it at 39.50. I had to wait well into Friday afternoon to get it, but I got it. And since I closed ZB, my long duration was a hedge against any negative beta event that would happen. Since I closed that, I have too much beta exposure, so this being short gives me some negative beta, which is what I needed. And I've got some good carry in here because I am short at 39.50. The index closed at 38.95. There's $65 of carry in here. It's negative carry on the long position because the curve is for financial futures always in contango. So long positions always have negative carry. If you're short, you get positive carry. Multiply that by 50. I've basically got $3,300 in there of positive carry. 50-day moving average, we're sitting just below it right now, 389.68. The 200 is 398.76. If sentiment remains positive all the way to Thursday, and Thursday is a good read, you could test the 200-day moving average. I don't know that you could trade up to 18 times earnings, being that the expectation for earnings is negative 2.2%. And negative 6.7 if you exclude energy. Implied volatility keeps dropping on this as well. Last week we had 32, 27, and 22. This is the implied volatility percentile, 52, 26, and 13 weeks, down to 16%, 20% at 26, 25 at 52. Using a 20-day at-the-money straddle just to compare it to last week. Last week, the 20-day at-the-money short straddle paid about 4%. Now it pays 3.72%. You can find individual underlying names that pay 8 to 9%, and looking even at Tesla, you're looking at 20 to 22% on the short straddle. There's just better places where there's volatility to get premium, so that's why I'm more apt to take the positive carry here and be short on something that has a linear payoff than to use options, because the premium is just too low, and I don't really need that convexity. Let's have a look at this week in earnings, and then we'll look at the economic calendar. Actually, we can skip the economic calendar this week because there really is only one thing this week on the economic calendar, and that's CPI on Thursday. The week coming up is not an exciting week at all. It's only Thursday, so there's not a lot guiding us till Thursday because there's no earnings until then, and there's no real significant economic report until then. So let's just head to this week in earnings, and let's break for lunch. Actually, I misspoke on that last screen saying that there's only one big economic event, which is Thursday. Tuesday at 9 a.m. Jerome Powell speech. Tuesday at 9 p.m. Before the market opens. So Expect him to continue with the same talk that he's always had. Maybe he's got some new talk, but I don't know that what he will say in a speech will end up being positive unless there's a Q&A after. He always tends to flub the Q&A. Well, there it is. It's Tuesday at 9. Be aware of that. Okay, so 2022 Q4 year-over-year earnings are expected to be negative 2.2. Excluding the energy sector, estimate is negative 6.7%. And here's what it looks like so far. We do have some companies that have reported that have reported earnings to date for 22 Q4. 75 have reported earnings above analyst estimates, albeit lowered estimates, compares to a long-term average of 66.3. Revenue is expected to be 4.1%, considering that inflation is much higher. Real revenues are significantly lower. Excluding the energy sector, growth is estimated to be 3.3%. So if you exclude the energy, we can probably use core as a proxy. Core is about 5%, so we can see that we do have some either zero or negative real growth in revenues. Let's just go down to see who's reporting earnings this week. Here we are. There's nothing all week long, and no, that's negative surprise. Let's keep going. There's a Monday, there's Tuesday, there's Wednesday, there's Thursday, and look at Friday. Look how much is going on, all before the market opens, 8:30. Bank of America, Bank of New York Mellon, BlackRock, Citigroup, First Republic Bank, JP Morgan, Wells Fargo. That's a lot of banks, a lot of financials reporting. You got United Health in there, and you've got Delta Airlines in there as well. $1.33 versus 22 cents a year ago. But these are, for the financials, that's a lot of event risk in there. And that's it for this particular week. Longer than I was hoping it would be, but there's just so much to get through.